We start with the market. Major indices all in the green this morning as the Dow, S&P, and NASDAQ all look for their sixth positive session in 7. The NASDAQ coming off its best day in over a month. Joining us at Post 9 is our own Bob Pisani and Mike Santoli. Guys, trade worries, trade fears, the story of last week, it seemed, but now what's going on? We're up about 259 points on the Dow. The S&P chart looks similar, up 0.2%.
Well, here you can see what happens when you have a weekend devoid of headlines about trade wars escalating. Nothing happened this weekend, essentially, and we saw a rally. We saw a rally over in China, which has been dramatically oversold. So where we are now, I think we got a great jobs report. So we have modest wage inflation, good job growth. I think the Fed is in a kind of dovish box right now that's positive for the markets. I think trade war remains the marginal sentiment mover that we've had. See, no talk. Market lifts. And the beat-up sectors, the industrials, materials, semiconductors, on trade wars, all start to lift. And I think the issue now is what's going to happen on earnings season. And, Mike, I think the bar is a little lower this time. Remember last quarter, everyone was anticipating we're going to raise the estimates for the second quarter, third quarter, fourth quarter, and they did. This time, from what I hear, I think people will be happy if they just affirmed the guidance for the rest of the year.
People are definitely primed for the idea that there's going to be some kind of second half softening up in the earnings estimate. So I wouldn't argue that at all. I would maybe go a little farther on the trade stuff and say we've used it up potentially as a negative catalyst for a while. I think you really have to get to a point where a lot more goods are affected, getting in and tariffs being put in place very soon, because what it does, to Bob's point about it being a sentiment mover, the S&P was at 2782 June 15th. It's at 2777 right now. Had a 3% dip. You actually had sentiment looking a little bit optimistic at that point, and it's really become very subdued. And Treasury yields have come in. You've had this defensiveness come into the market, I think, because of all the trade headlines, and that sets you up for a little bit of just relief, as Bob says, on no incremental trade headlines.
The remarkable thing is the rotation. Remember, I talked about this in the early hit at the open. Normally, this time in the presidential cycle, these two quarters, it's terrible. Normally, the S&P is down in these two quarters. We are actually up 4% since the end of the first quarter because we've had this wonderful rotation into these defensive names. So we've seen REITs, we've seen utilities, we've seen healthcare, we've seen consumer staples. With not a market leader, suddenly it's become a modest market leader. And if everything else is held back, the banks, the industrials, materials, and semiconductors, if this trade war eases, you'll get a rotation back in. That's why this is such a powerful market. There's just nothing that comes in and dramatically keeps selling off. Something else comes in, they start buying it.
Okay, so we've seen a bounce in equities, and some of these trade war fears seem to be kind of getting sloughed off right now. Not necessarily so in the bond market. I mean, look at the 10-year right now, it's 2.85. Yeah. Which market's right?
I don't know if there's a real serious argument between the two markets right now. I think the Treasury market is going to trade off of the Fed expectations, off of the inflation outlook. Wage inflation did not really give you a reason to get too scared on Friday. So right now, I think we're range bound with Treasuries. We're kind of range bound with stocks still. As I said, you go back 3 weeks, we're flat for the S&P 500. Although I do think it's interesting when you're hearing this talk of Fed governors coming out and saying, well, look, maybe we should not even tempt a flat or inverted yield curve. We might actually have to wait if we see the curve flattening even more before going. So, maybe that's taken as a dovish.
I've still got the image, Bob, of that dovish box in my head. I'm seeing Princess When Doves Cry video from...
Or the magician that lets the dove out of the box.
But I wonder, the president's calculation has been that if you're going to fight a trade war, now is the time to do it with the economy on the pace it is. Yeah. What is the market telling us about perhaps that calculation or its resilience in the face of this pressure he's trying to put on other countries?
The market is telling us that the base case is that the trade war will not escalate into a really serious conflict. That's what the market's telling us right now. That could all be totally wrong, but that's clearly the bet. Somebody earlier said 30% chance of a serious trade war, 70% chance of a very modest skirmish. That's clearly what the market is saying right now. I'm a little worried about whether that's the base case. Let me just say something about the interest rates. Yeah. The Fed has been raising short-term rates. The long-term rates are not not going up commensurately, and that's creating that yield curve flattening. Remember the global demand situation here. We're at 2.8% on our 10-year. Everyone else is 10-year. Look at Germany. It's flat, essentially. Japan is 0 and been negative at some points. The rest of the world is clearly coming in and interested in holding on to our treasuries at this point. So there may be some external factors that are a little unusual here. The fact that the rest of the world is still dovish while we're trying to raise our rates, I think is a little bit of a factor making our 10-year yield a lot more attractive globally.
All right, guys. This is what it sounds like when doves cry in the market. Bob, Mike, thank you.
And we miss Prince.
We do. We do.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.